Welcome back to Between Two Fiduciaries. This week we're going to be talking about direct indexing. I'm here with my partner Jimmy, and I am Jeremy. All right, why direct indexing? Maybe we should say really what is direct indexing, and this gives us a little bit of an idea in a continuum of different options that are available to investors. But Jimmy, kind of give us the real quick skinny on direct indexing.
Yeah, so the long story short is direct indexing is basically deconstructing the individual holdings within an index and owning enough of the securities within that index to replicate the performance of that index with a very, very small tracking error to that number. So the most common index that we utilize or that we talk about and discuss is the S&P 500. As it would lead you to believe, there is approximately 500 stocks in the S&P 500, and the studies have shown that owning somewhere in the 300 to 400 stock range is able to provide you almost the exact same performance as the S&P 500.
Got it. So people are familiar with investing in a variety of different ways. Individual stocks, also known as equities, mutual funds, ETFs are an efficient way to do that. But this is back to the old school way of owning individual stocks, yes, but it's giving you the diversification of a full-blown benchmark.
That's well said. The mutual funds I think are probably the most commonly recognized investment for most of the clients that we see because mutual funds fill up 401k and other retirement accounts. So when people look at their 401k statement, they're accustomed to seeing and reviewing mutual funds. And again, these mutual funds are comprised of individual stocks and bonds, and they were originally created to democratize and allow more people access to a diverse set of investments. This direct indexing is taking that to the next level.
All right, the objectives of direct indexing kind of refer to this as like a trifecta of different objectives and benefits that you get out of it. Jimmy, you mentioned track the benchmark. They want to be within less than 1% difference from what that actual benchmark is. In this case, we're using the S&P 500 as an example. Oftentimes, you can get very, very close within a few points of that benchmark, right?
Yeah, that's exactly right. So, effectively, what direct indexing's primary approach is, most investors want to try to beat the benchmark
Right.
from an investment return perspective. Now, what we've discovered over the years is, beating let's use the S&P 500 as an example again, beating the S&P 500 as a benchmark from a performance perspective has been very difficult for even the savviest of professional investors. They might be able to do so over a short period of time, but there's very few that have been able to do so over long periods of time. So their stock selection has not been good enough to outperform. So what the direct indexing is trying to do here is play a slightly different game, and that's where you see the harvest losses coming in there as part of the trifecta that you mentioned, which allows you to, in theory, potentially outperform the benchmark on an after-tax basis. So it's playing a slightly different game than what most investors are accustomed to.
And we'll break that down in a moment. The other aspect, obviously you've mentioned it, is you just want long-term appreciation with something like the S&P 500. It's over the last 50 years, it's averaged about 10% annualized. And it's worth noting, as we say in here, these are good for non-qualified accounts, after-tax accounts, right? Not your retirement accounts like your IRAs or your Roth or your 401k, 403b.
That's a great point. This is absolutely specific to non-retirement accounts.
Okay, so one of the ingredients that really makes a big difference within your capacity to do tax loss harvesting is going to be some volatility. And normally people look at volatility as a foe, and here we're kind of flipping the script and we're saying it's more of a friend in this particular category.
Yeah, absolutely. So the ideal market scenario for a direct indexing strategy is one that does have volatility. The opportunity for the direct indexing strategies to provide more alpha or outperformance as relative to the benchmark. The more volatility, the more opportunity for the tax loss harvesting to create an edge there. So, a year like 2021, where you can see in this left chart here, where we're up 28.71%, there was not as much room for tax loss harvesting opportunity there as there would have been in 2022. Not to say that there was none, but there was just less. And that's what is important to see is that in the chart on the right there, we look at even in 2021, given that we're up almost 30% in the S&P 500, you still had almost over 90% of the 500 companies in the S&P 500 were down at least 10% at one point in time during the course of the year. So really kind of mind blowing when I saw that number in the graph there. It really strikes you as that while there was a lot of opportunity to still harvest losses while the market was trending up basically the entire year.
Two very different years with similar effects when it comes to some sort of a drawdown.
Absolutely.
A significant drawdown as well. Okay, so tax loss harvesting. Let's use an example before we dive into the actual slide here. So within the benchmark, there are companies like Ford and General Motors or Pepsi and Coca-Cola, right?
Mm-hmm.
These are both similar companies. You could swap one of them for another within the portfolio, maintain your tracking error from a sector perspective, and maybe be able to take advantage of some tax losses, right?
Absolutely. So one of the key components of the tax loss harvesting is you don't want to change the complete risk profile of the investment portfolio just to harvest tax losses, and that's really what we're trying to achieve here. In the example you give, whether it's sell Coke by Pepsi, sell GM by Ford, whatever the case may be. You want to maintain the overall risk profile of this investment that make sure that matches up with the client's risk profile, with their risk tolerance, and with their goals.
Got it. So the capacity is there within the direct indexing portfolio to be able to take advantage of some of these tax losses. And then what is the question, right? And so this is what here we're trying to kind of break down and dissect for you. Jimmy, walk us through it. We've got investment A, you gain $20,000, you have a $20,000 gain in capital gains, right? And then in investment B, you sell for a loss, or you have that loss somewhere in the portfolio, and you use them to offset one another, right?
Yeah, exactly. So, we obviously would much prefer to always have gains in the portfolio, never to have losses. But as the previous slide showed, even in years where the market's up quite a bit, there's still underlying stocks within the index that are typically held at a loss for the year. So what we're trying to do here is say, okay, we have this position at a gain. You pay tax on gains unless there are losses that offset those gains. And so you can see here investment B has more of an unrealized loss than investment A. So selling both of these at the same time allows you to offset the potential tax that would have been owed on the $20,000 gain in investment A. And that $20,000 is then immediately offset against a $25,000 capital loss in investment B. And in addition to that, if you have more losses than gains in the course of a calendar year, the IRS allows you to deduct up to $3,000 per year against your other sources of income. So in this example, you can see there's some real opportunity for tax savings based on a strategy that deploys tax loss harvesting.
And lastly, I'll add to it, if you have additional beyond the 3,000, right, you can carry over into the future those additional losses to use them in the next calendar year.
That's exactly right.
Okay, we're going to go through a quick summary here of direct indexing. So we've mentioned this before, it's the trifecta. You get the benchmark long-term appreciation, you get that diversification from a wide hundreds of stocks in the example that we've provided, and great tax efficiency. It's good for non-qualified accounts. Those are those non-retirement accounts, after-tax accounts. It's great for high income and high net worth. Use gifting as an example here for us, Jimmy. Tell us how that works.
Yeah, so if you think about this, let's continue to use the S&P 500 as an example. The S&P 500 has provided wonderful investment returns. We're moving 2022, but if you go back to really coming out of 2008, the S&P 500 has been averaging well into the double-digit returns. Most of that return has been driven by a select few companies. And I think, again, most of you would recognize these names. It's the Facebook, it's the Apple, it's the Amazon, it's the Netflix, it's the Google. Um, when it comes to gifting as an opportunity for those that are looking to, make gifts to either to their children or to charities or whoever the case may be, it's far more tax efficient to be able to gift individual shares of the stocks that have provided the most appreciation along the way. Gifting a share of a mutual fund or an ETF that tracks the S&P 500 will be helpful, sure, but just not as much so as if you could have if you actually own the underlying holdings, such as use Apple as an example, and the gains you've had there. You can gift shares of Apple that maybe you put in, let's say you put in $10,000 and now it is, $50,000. Well, there's a $40,000 gain you have in there, and you're able to gift that $50,000 of value, and you only paid $10,000 on it. So there's an example of where you can the customization and owning the underlying holdings really offers some more opportunity for gifting strategies.
Number 4 here, account minimums. There is, and this has really changed over the last few years, but now there's about a $50,000 minimum to get into a lot of these. Some other companies, some money managers out there have a much higher threshold, but we're starting to see that level down to as low as $50,000. So, and then lastly, we've got the customization. Talk to me about that.
Yeah, so the customization, again, an example of how many stocks that have been owned in the mutual funds and the S&P 500 that have provided most of the outperformance in the past decade plus. Those stocks we mentioned before, maybe you own a big chunk of those in other investments, and so you don't want to own a lot more Apple or Amazon or Netflix in this direct indexing strategy that you're wishing to utilize. And so you can do things to customize and say, you know what, maybe instead of the S&P 500, I want the S&P 495, and I want to remove these 5 stocks from my strategy because I already own them in a great capacity in other investments.
You have an overexposure to them elsewhere. Why replicate over here? You can now customize.
That's exactly right.
And it's quite easy to do.
And that's just one example. There's far more that we could get into for specific individuals that have concentrated positions, or that they are employees of publicly traded stocks or publicly traded companies that they have a lot of company stock in their portfolio already. So there's a lot of really neat customization that can be deployed in a direct indexing strategy.
Well, folks, that's all we have for today. Direct indexing, trust us, you will hear a lot more about this. We are on the cutting edge of this. And if you have any questions, please reach out. Thank you so much.